The term the American dream was coined in the 1930s, giving name to the hopes and expectations of migrants and Americans themselves. And one of the ways many people intend to achieve this dream in their lifetime is buying a home. However, the prevailing story on the modern housing market for quite some time now was that millennials were not making purchases. It has been the prior generation's running narrative that millennials are simply cheap, lazy, or too nomadic to commit to something as significant as a mortgage. But is it really the new generation's fault that the American housing dream is falling apart? If you're new to this channel, welcome. And don't forget to leave a like and consider subscribing for more videos about real estate, housing, news, information, and click the notification bell below to get notified whenever we upload new videos. Among all home buyers in the United States in 2021, first-time home buyers accounted for approximately 34% of the total, with the typical age of a first-time home buyer being 33 years old. The share of first-time home buyers among all buyers in the United States has been fluctuating significantly between 2003 and 2021, with 2010 having had the highest share of first-time home buyers being 50%. However, this year, first-time buyers made up just 26% of all home buyers in the United States, an all-time low over the 4 decades that the National Association of Realtors has been conducting its survey. And now, the typical age of a first-time homebuyer has grown to a record 36 years old. However, there are many factors that contribute to why the American housing dream is falling apart. Millennials coming to age in the wake of the Great Recession dealt with high unemployment and a lack of affordable housing. Let's take a look at why housing has been out of reach for so many. This year, the U.S. housing median prices increased at a record high of $413,800 in June, until it dropped to $389,500 in August and $384,800 in September. This increase of the housing prices is a result of a higher demand than the supply in the housing market, which indicates a housing bubble. But why are we experiencing a shortage of homes if there's plenty of real estate out there simply sitting empty? Well, this is due to private equity firms buying and investing in newly constructed neighborhoods to make for the sole purpose of rentals. This makes the housing market tougher for normal working individuals. John Burns Real Estate Consulting found that investors purchased 33% of single-family homes in the United States since January. This percentage is the highest in the last decade. Apart from that, foreign investors as well as foreign equity firms are also buying newly constructed homes as a form of investment. These private equity firms and foreign equity investors are free to buy entire neighborhoods and turn these newly constructed houses into rentals instead of selling them. They're able to earn high profits from the rent and at the same time earn the equity as the house appreciates in value due to lack of supply, which they are actually contributing to. This leads to low supply of houses to buy, which in turn leads to a high demand and skyrocketing home prices. So not only are you competing with Bob and Karen down the street for a home, but you're also competing with bigger investors, which is much tougher to outbid. And this cycle goes on in a loop, driving prices higher and higher without any laws or regulations to help level the playing field for ordinary home buyers that just want a place to live and raise their family. If you're an ordinary working American with student loan debt, putting a big dent in your bank account, it's impossible for you to outbid these investors. And therefore, if you want to own a house, you have to acquire a mortgage, which also puts you at risk for piling up more debt. Additionally, since 2008, there have been a regulation in the banking industry that aims to prevent the predatory lending that led to the 2008 economic collapse. And big banks have since tightened up their lending standards, which makes it more and more difficult to qualify for a mortgage. Immediately following the 2008 crisis, some lenders required upwards of 30% down on new mortgage loans, something to look out for as we head towards another potential housing crash. This is leading some people to become desperate and seek out these non-bank lenders, which are basically non-depository lenders that are not owned by or affiliated with a bank or credit union. Therefore, non-bank lenders don't have to abide by the same regulations that the traditional banks do, which leads to predatory actions over those who might be rejected by the traditional banks. According to Dana George from The Motley Fool, non-bank lenders are more likely to lend money to borrowers who might be rejected by traditional banks. For example, a borrower with a low credit score or someone hoping to purchase a home that will require a lot of renovations is more likely to be approved by a non-bank lender. Non-bank lenders can't take checking and saving funds from other customers to use to create mortgage packages directly. Instead, they borrow the money on a line of credit from other investors and then use these funds to create mortgages for home buyers. Once the mortgage is established, they then sell the mortgages on to other investors. According to the Brookings Institution, the danger is that non-bank lenders depend on short-term credit to finance their loans, and markets usually tighten in times of financial crisis. In 2016 alone, non-bank lenders have ended up lending about 50% of the outstanding mortgages, which leads to them over-leveraging themselves while also engaging in mortgage-backed securities. These mortgage-backed securities are also being traded in the stock market, which poses the risk of hurting yourself once the economy collapses. Now this leads us to the matter of unemployment. With the Fed issuing its largest interest rate hike since 1994, the unemployment rate is set to increase despite still having 4 million jobs short of where we were before the pandemic. Based on the Fed's logic, if they increase the interest rates, it'll be more expensive to borrow money. But this only means that fewer people will be able to start or grow their businesses. This will cause a domino effect. With fewer businesses and less investment capital available, companies will slow their growth rates, which will lead to fewer jobs for employees, which means more competition in the labor market and people being forced to take jobs with compensation below their skill level or in line with the amount of work that they do. Once wage rates start dropping, people will have less expendable money. There will be less spending into the economy, and overall demand will go down. This is how the Fed hopes to cool off inflationary trends and stabilize pricing. Now, if that doesn't sound like some strong medicine, it gets a little worse, because even the Fed doesn't think that this plan will work. During congressional hearings, Federal Reserve Chair Jerome Powell was asked by Senator Elizabeth Warren if the gas prices will go down as a result of the interest rate increase, to which Jerome Powell answered, "I would not think so, no." And when asked if the Fed's interest rate increase will bring down food prices, he answered, "I wouldn't say so, no." So everything going on from the COVID pandemic, supply chain break issues, shortages from sanctions and war, all these can add up to the higher costs of goods and services. But some corporations are seeing this as an opportunity to make more money. More corporations have begun taking advantage of the situation and increasing the prices of goods more than just to account for additional production and transportation costs. Amid the pandemic, Procter & Gamble issued a price hike to its products due to the increase in raw materials price, as well as production and transportation costs. But a couple of months after the price increases went into effect, it was reported an almost 25% profit margin. CEO and billionaire John Catsimatidis said, "You know how CEOs are in Wall Street? They live quarter by quarter. If they're off by a penny in earnings, Wall Street is not forgiving. So, what are the CEOs doing? They're raising prices. I see food prices going up. Promotions are down to zero. Why give something when you don't have to give it away? And you make more margin." So, not only are regular homeowners worried about their mortgage, but now you also have to take into account the increasing gas and food prices, while also thinking of ways to get and keep a job in order to pay for it all. It's clear that today the American dream of affordable housing is in deep trouble. Decades of deferring to the wealthy and policies that have shrunk the middle class have taken their toll on the stability of the economy. To fix this, we need strong leadership as well as new laws and regulations that can put regular home buyers on equal footing with larger investors and corporations, all when purchasing homes just to live in. So what do you think? Is the American dream of affordable housing dying? If so, how do we save it? Let us know what you think in the comments below. We'd love to get your thoughts on the housing crisis and how it's affecting you and your community. And if you like this video, don't forget to hit the like button. Subscribe for more content so you can stay up to date on all the latest news, info, and tips relating to this turbulent housing market. Thanks for watching.